We're not mic'd up, so if you can't hear us, you might want to move up since we have a lot of space in the room, then we don't have to shout from the front to the back. To get started, this is all about finance and funding for you, and I'm going to introduce our panel here. Beginning kind of in the middle, we have Gordon Daugherty, right?
Yep.
And Gordon is an entrepreneur and author. He's a startup investor and an advisor, and currently you're the president of Capital Factory, correct? So I'm going to let you introduce yourself. Just kind of tell us about Capital Factory and what you do.
Okay. So I spend 100% of my time educating and advising and investing in tech startups. I do that through Capital Factory. We're a large-scale startup accelerator and incubator. About 2,500 tech entrepreneurs called Capital Factory home last year. We run an accelerator program, venture fund, and basically we refer to ourselves as the center of gravity for tech entrepreneurship in Texas.
Great. With Gordon here, we have Paul Gerling. Paul, you are with Comerica Bank and currently kind of oversee the Central Texas market. Tell us about Comerica, kind of specifically, what you guys do and your role at the bank.
Sure. So we're a large bank, $70 billion organization, largest bank headquartered in the state of Texas, which as an Austin kid, I kind of like that. We do have major operations in Texas, Michigan, California, a little bit in Florida, a little bit in Arizona. We are primarily a business bank. We focus in on businesses and specific business niches. My group in particular focuses on general manufacturing service companies, distributors, that type of thing. But we have a lot of niche businesses in technology and life sciences, wine lending. We actually finance movies out in California. So there's a lot of interesting things to talk about.
Thank you. Blake Richardson, First Texas Bank. You just joined the bank not too long ago. Tell us about First Texas.
Yeah, I've been with First Texas for about a year and a half now. I'm originally from the Houston area, but First Texas Bank, it's a community-based bank. We primarily deal with businesses as well, like Comerica, more small businesses. We are the second oldest bank chartered in the state of Texas. We've been around since 1898, and they intend to keep it lasting a whole lot longer than that. But I've always loved the community bank feel. You get to know the people that you work with. They get to know who you are, and that's how you can very well cater to their needs and understand what they need to help grow their business and help them be successful.
Great. And then Brian Marshall, you're the Director of Entrepreneurship at BCL. You can kind of explain that. Well, I think you may have the most interesting role, or at least geographically. You focus on 250 counties in Texas, so you're very diverse.
Yep. And we are a kind of a player overlay in between these other organizations. So BCL is a community development financial institution, basically like a community bank. We focus on communities, but we have a lot of flexibility in our lending. But then the other piece with like Comerica and some of the other banks, we partner with them. So certain types of loans that they may not consider that fits in their model, then they can partner with us as well, and then that could be a referral to us, and it may fit in our wheelhouse. And then the same with the tech businesses. They roll through BCL as well. They're just at different stages. They may be a tech-enabled business where now they may want, we call it, they want to grow, they say grow up, which is where they want to put some debt under the business, and they come through us as well.
Okay. So we have a wealth of experience both kind of on the equity side and as well as the debt side. My name is Ray DeLauder. I own a small firm called Vantage CFO, and we play the role of kind of a CFO for hire for a variety of different companies in a handful of industries. And so hopefully I can bring some unique questions and perspective. But it would really help us if we knew a little bit more about you guys. So a couple questions, and maybe just by raise of hands, you guys can let us know. How many of you, raise your hand if you have been in business for less than a year? So we've got established companies. Maybe I should back. Okay.
I haven't started.
Hadn't even started yet. I was going to get to you. Right? I wasn't going to not hit that question. So from thinking about it, okay, and then how about in business for say less than 3 years, 2 to 3 years, 3 to 5, okay, 3 to 5 a few, 5 to 10. Okay, 5 to 10, more established. Anybody in business more than 10 years? Okay, so we got a couple. So we're pretty diverse in that set. So being that this panel is really about capital markets and funding and finding funding, if I start at just a really high level and we just take funding and say, we've got debt on one side and equity on the other side. Start by talking about, as a business owner, when should I be focused on the debt markets versus the equity markets? And I'll start that, maybe Gordon, with you.
Well, in the world of tech startups, since in the early days you actually have no assets, no tangible value, what you have is an idea on a napkin and what I call hope, vision, promise, and potential, probably debt instruments are not available to you unless the founder is going to personally sign for that debt, and I'm going to yell at them if they do that. And so I think in the tech world in the early days, giving up equity in your super fragile, super risky thing, well, that's an easy decision. So that's what I always see, and it's much later as the startups get into the market and have a revenue stream and other things that they might be able to convince, a banker or some other form of financing to kind of go that debt route.
Yeah, and I'll chime in with that as well. So if you, from the debt side of things or the debt equity play, what we're really looking for is does the business, if you are in, let's say, validation startup phase, you've passed the idea, now we're in the stage of we've taken this thing out the dock, we're maybe 6 to 12 months in, and now the debt or lender, for me, I'm looking for not what it is, what does it do? Meaning, does it make revenue? So you got to consider that. It's a capacity and capability question. I'm asking you, can you afford the loan based on you need to understand your revenue and profit margins, because that's where I'm going to look. It's going to come from the profits to pay for the loan. So that's kind of what I try to tell some folks to think about before you consider is really addressing the issue, because we look at things kind of differently on the risk side of it.
So I have to chime in too. The other thing you have to keep in mind is that the amount, debt is not just one thing.
Yeah.
There's a big spectrum of debt. And of all the lenders out there, whether they're regulated bank lenders or not, there's a spectrum. And you have to have one of two things. You have to either have collateral, or you have to have cash flow, or you have to have both. So there are some lenders out there, they really don't care about your cash flow. All they care about is the value of that asset that they can sell if you don't pay them back, right? The liquidation value. There's other lenders in this particularly large buyout kind of financing. They really don't care about the assets. They just care about the cash flow. They want to make sure that your cash flow is seasoned, you've done it for a long time, and they can rely on it to repay your debt. Most lenders, most bank lenders are kind of in the middle, where you got to have both collateral and cash flow to go along with it. So when you're thinking about debt, you really have to kind of think about the universe of what's out there. And we can get into more of that later.
So a follow-up question, because something that I've seen multiple times is a company will come to a commercial bank and they're looking for funding, and their source and their model of repayment of that loan is the cash is going to be generated from the use of
The
funds,
future.
right? From the future, right?
Right.
So for you, Gordon, and maybe Blake as well, being in that commercial banking space, kind of explain to the small business owner, right, how you look at existing cash flow versus expected.
Sure. You want me to start?
Yeah, you guys go.
So, and this will touch on the tech piece too. One of the things that a lot of bankers just don't really tell you, it's like secret sauce, but we are all regulated by the federal government or the state government, and we have to grade our loans from 1 to 7, right? 1 being the best, 7 being the worst. There's usually a line in the middle, like 4 or 5, where you kind of drop into the not so good credits. And there's basically 3 criteria that the banks will look at. 3 sources of repayment. Number 1 is cash flow from the operating entity. That's number 1. Number 2 is liquidation of the collateral underneath that loan. And number 3 is the support from the guarantor. If you have weakness in cash flow or collateral, that will pretty much automatically drop you into that not so great category, and the bank's not going to want to make you that loan. Okay, so whereas a traditional bank, my group will underwrite historical cash flow. We go back 3 years, see what that historical cash flow is to substantiate future debt repayment. Right, that's really what a commercial bank does. The people who work with tech companies, it's a little bit the opposite. They are looking at that company's ability to raise equity to pay back future debt, to create that cash flow going forward. But in order to do that, you have to have a venture capital or private equity investor in the deal already, and there has to be some actual revenue traction there to make that kind of all come together. So.
Wait, can you add to that and talk a little bit about coverage ratios and kind of explain what you're looking for and what a coverage ratio is?
Right. Well, Paul really hit the nail on the head talking about the whole ins and outs of banking. That's pretty much the overview of how it is. Basically, like I say, cash flow, or collateral. Those are 2. Well, cash flow is not one of the big C's, but it's that extra C of the 5 C's of lending. But yeah, like you said, some people are cash flow lenders, some people are collateral lenders. But when it gets to that startup area, that's where we're kind of on the fringe. But it also depends on what type of business it is. Me and Gordon were talking earlier about startups, and there are some kind of startups that don't require a lot of money to get established. I think we were talking about a lawn mowing business, and so lawnmowers, a couple of those, that's several $1,000s, and that's just that first tier step of maybe establishing a bigger and better thing down the road. And so something like that's more manageable. But also kind of what Paul was saying, being in banking is, I think the majority of our jobs are keeping up with regulations.
Yeah.
That is primarily the hardest thing to do, is find out when and how we're about to do something wrong, and making sure that we're going to stay consistent when we're lending, because fair lending is a big portion of what we do, is making sure that if we deny somebody, we deny somebody else for similar or the same reasons. And so consistency is a big key that we have to look out for. And so depending on how you're structured, bank from the lending side and what your operations like, per your policy and procedures, there's going to be little pockets of wiggle room that you may be able to move forward with getting financing for, and then in some cases there may not be.
Can I chime in with something with Blake and Paul? So I want you guys to understand this in my 3-year to 5 to 10-year businesses. Some of you are operating possibly in startup purgatory. You have been operating businesses for 3 to 10 years, and you've been operating some of these businesses as a freaking startup. What do we mean by that? Do you have your key performing goals set for the business? You've been operating a business for 3 to 5 years, and what's profit? What's revenue? So keep that in mind as we look from the lender perspective in many instances. As you're coming to us and you're saying, well, I've had this business for 3 to 5 years, we're still going to ask some of the same questions. I get businesses that have been operating for 5 years, and I say, what's your revenue number? And they give me a profit number. So just wanted to put that out there on looking at your business and where it is. Is it a growth business? I mean, do we have an identified market that we can scale and grow into? Or are you still not focused on those things, and your behavior is that of a startup?
That's a good point. One of the things you're hearing from Gordon and Blake is, if you're coming to a bank and you're looking for financing, that financing has to be supported by the existing business. you're not going to be successful going to the commercial banking market trying to get financing that you're going to support with future growth, right? That's a very critical thing that I think a lot of young entrepreneurs or early entrepreneurs kind of miss. Bank debt, right, is traditionally kind of this lowest cost of capital that's out there on the market. And so I wanted to ask a question about just maybe explaining the relationship between cost of capital, what is cost of capital, from, the various types of financing that are available in the market, from debt all the way to equity. And Gordon, you have a perspective being on the equity side, that's your highest cost of capital. Maybe you could kind of talk about that a little bit.
Well, is it your highest cost of capital or the lowest cost of capital? It depends on how you look at it, because the way I think of it is a venture investor getting equity in the company, the outcomes are mostly binary. It's either zero or something maybe really good. Of course, there's some partial returns of capital, but the way I think about it as an angel investor in my personal portfolio or as a venture capitalist, we really are playing portfolio theory because we get equity in the companies. And as an angel investor, just the early stage, I assume that half of my investments are going to go to zero. Okay, crash and burn, didn't work out. Okay, I got it. And that only 10% are going to give me a 10x, 20x, maybe I get lucky and get a 50x return, and which means those other 30 to 40%, yeah, I'll get some of my money back. So it just completely changes all the behavior I'm looking for. Is there a really large market? What are the odds you can get this to $100 million to sell the company for $500 million or go public? Because I know that half of the investments are going to go to zero. So like when you think of cost of capital, well, if you're one of the ones that went to zero, there was no cost of capital, right? And if you have a really big exit, okay, I invested $50,000 in the beginning and I get $500,000, but you exited for $500 million. Right. So it's
and there's no cost of capital in that situation, but you've taken the risk,
I'm
right?
taking the risk.
Right,
Yeah,
and
yeah,
having
absolutely.
taken the risk, in order to entice you to take that risk,
Yes.
the business owner is going to have to show you a higher return than what he would have to show the
Maybe
bank.
upside,
So
exactly.
yeah, right, because in the bank taking lower risk.
Yeah, so I mean, really, to me, everybody wants to get the lowest cost of capital, right? That's the goal. But it's more important to think about what's the appropriate capital for what you're trying to accomplish, right? So if you think about, the last fund in my firm before, we had a 33% return, right? Pretty good return. In a bank, your average return is 1%, right? What that means is that if I lose $1 million, I have to make $100 million worth of loans to make up for that $1 million loss, right? So if I were in an entrepreneur's shoes or a business owner's shoes, I kind of think about this as what's the, number one, are you going to match up your funding with the assets or the cash flow that you're trying to produce? So if you're wanting to finance your receivables and need working capital, then short-term funding from a bank makes a whole lot of sense. If you're buying a piece of real estate or equipment, longer-term financing makes sense. You really would not want to finance that with short-term, line of credit. When it comes to debt and equity, I call it the can I sleep at night theory.
Yes.
That if you have a growing business and you're going to grow rapidly, bank debt is probably not terribly appropriate for that, right? You need to have some sort of stable capital within your capital structure so that you can sleep at night to know that you have the resources in order to achieve that growth, right? And again, we could talk for 4 hours on that one subject alone, but that's kind of the way I think about it. Is if I can sleep at night knowing the funding sources are matched up with where I want to go, then I can pretty much sleep well. If they're not, I get uneasy.
All these guys, whether they be investors or bankers, they're in business for a reason, right? To ultimately earn a profit for their organization. So as a business owner, that's your cost of capital. It is the cost of you getting these guys involved in being able to fund your business. The landscape of the debt markets, we say debt, but that's a big landscape of all kind of different opportunities. Maybe Brian, you could talk about some of the different avenues within.
Yeah, that's a good one. I just went, oh yeah. Some things to consider when you look at debt and access to capital. You brought it up earlier. Know in advance when you may need this, and it's going to really depend on where you are in your business. A good example, not to pick on them too much, we do have predatory, or they appear to be predatory small business lenders. You can get the money in 48 hours, just click here. Well, the challenge, that is true, but many times those are, you might be at a point where you need the money, hey, I gotta meet payroll by the end of the week, and you're freaking out, and that's what that landscape looks for you. Now granted, I had one of them was taking 25% of total gross off the business every month, which created a huge cash flow problem in this business. So that's one thing I think you need to understand, is that you've got your traditional bank, community lenders, and then you've got this online source of access to capital. All can serve you, but with caution of what you're getting into. That making sense for some of you guys? So ideation and startup, to your point, I'm always try to get the business off the ground without any debt in it. So validate the process is really where I tell you to start. In some instances, you may come to me wanting 50,000, and when we back into the 50,000, you're basically telling me you want 40,000 to fund your household, and nothing goes into growing the business. These are real. And then with the lenders, Paul, I'll put it this way. If you get 50K from me, I want my 50K back 3 years at a certain interest rate, and I'm good. That's all I'm interested in. If we get some growth, great. Versus, hey, Gordon, we're at 20x, 30x, and they have a higher risk tolerance versus the traditional lender.
Same thing on the equity markets. Gordon, I'll let you chime in as well. But on the equity markets, talk about the various types of equity and kind of how that aligns with the life cycle of a company.
In the earliest days, in my world, the companies don't actually sell equity, and that's because we can't agree on a valuation of the company. Before they've gotten a product in the market, or maybe they've just got their first paying customers, we're just going to sit there and argue for so long over valuation that it's going to take, it's going to take too long. So those startups usually raise money using convertible securities, a convertible debt. It looks like debt, it smells like debt, it has an interest rate, it has a maturity date, but I don't want you to pay me back my $25,000 plus interest. I want equity in your company. I want to sit on your cap table, so that debt converts to equity in the future. And there's formulas, and there's ways that I get better terms than the future venture capitalist. When you get to $1 million in revenue or more and kind of have a track record, then you can sell equity to the investors, and they want a special class of equity. They don't want that common class equity that you have if you're a C corporation, which is what the VCs will require. They want a special class of equity called preferred equity, and then they get special rights with that. They get their money back first if you sell in distress. They get rights to not get diluted in the future by investing more money. They might get a right to sit on your board of directors. So there's other influence and special goodies that those venture capitalists get when you reach that point.
You're even before the VC stage, is what you're.
I am before and during the VC. So I wear a hat as an angel investor. I also wear the hat as a VC, investing in Series A and Series B rounds of funding.
Yeah.
Yep.
And as you move forward, kind of through your life cycle as the company's growing, then obviously the terms start to change as people are looking at a different risk profile at that point.
That's right.
Paul, do you have a comment on the debt side?
No, I was just going to say again, to Brian's point, just understanding what that cost of capital is and what does it mean and how do you have to pay it back. And again, it sounds silly, but it goes back to that, how do you lay your head on your pillow at night and sleep well, knowing that you have your business financed the right way.
I have a question for Gordon. Hybrids, tech, and maybe a tradition. We've got a young lady it's lemonade, and that's running through angel investors.
Yeah.
Talk about that a bit, because you may have. I see some mixes of that where, hey, I've got a juice business, and I want to make it global.
Yep.
Do you see hybrids and
Definitely
how does
hybrids.
that model work?
You know, in the CPG, the consumer packaged goods world, you'll see kind of tech-enabled CPG or tech-supported CPG, services companies. There are services companies that are incorporating, I don't know, artificial intelligence or other forms of technology to be a different form of services company. For sure, we see that. We debate this at Capital Factory because we're tech-focused, really tech-only, and then here comes these hybrids, and we've debated, like, what do we do with that? And part of it is, do we know what questions to even ask? Because I know how to ask the tech questions, I don't know as much how to ask the CPG questions. So if they're going to go through retail distribution and sit on the shelf of HEB, I don't know that. I do know the tech part of it. So we have invested in hybrids. We brought hybrids into our startup accelerator.
Yeah.
I see angel investors. See, angel investors are interesting, and that's just because they're high net worth individuals. They can invest their money however they want. So even if they made their money in tech, if they see something about the tech in a hybrid tech CPG or tech-enabled service, that high net worth individual can invest in whatever they want. They don't have rules and boundaries. They
They will
invest
make you
in
come.
what they're comfortable with.
Yeah.
So I do find services companies and CPG companies that can raise money from angels that have been there, done that, and made their money
Yeah.
in something that relates to that small business.
And some of those same angel investors will make you come over and paint our house and
Yeah.
seriously.
But angels become advisors too. That's why
Yeah,
they're called
that's why.
angels, is they're not just in it for the money. Some angels are actually doing it so that they have bragging rights at the cocktail parties. They're doing it because they want to give back, and yes, they want to get their money back, but they're actually equally motivated by helping the entrepreneurs, you know, and this is their way of giving back, so.
And one of the things you're hearing in here is that, you know, when you're looking for that source of whether it be debt or equity, it's finding the fit, right? Because not every investor is looking for any opportunity. They're very focused a lot of times in what they're looking for.
Kind of like getting married.
Yeah, exactly. That's it, exactly.
And you can
Which
be a
one is step
hybrid
one?
business, so to that point, cupcakes, it could be anything, and these can merge, but hopefully what you get out of it is just, okay, where do you start first? So you could be in a debt equity business, really, and then go into, it could mature into a investor business. That can happen. Just know where you are, your products, where does it fit to speak to each audience.
I don't want to save the Q&A to the very end, so if you have questions, I want to start pulling in some questions from the audience. That way you have enough opportunity to ask. But I'm going to ask one more question, then I'll find one of you. The most common mistakes that you see when people come to you and if they're looking for debt at Comerica or First Texas Bank or equity, Gordon, what are those most common mistakes that these business owners make?
You can go ahead.
So how long do we have?
And I want all four of you to speak to this because I think you all four have a different perspective.
Yeah, I think you know the first part is just in the operations itself. You know, trying to understand exactly what makes money in your business. Brian was talking about this earlier before we started, just in terms of really understand what your balance sheet and your P&L are telling you. We have so many businesses that, yeah, they have an accountant that puts together their balance sheet and the financial statement, but I just honestly don't know what it means. And so, understanding what those two documents are, how they work together, and more importantly, how does that help you manage your business? That's probably, the first thing that we see with smaller companies and understanding that. A lot of folks assume if their CPA says they got to pay X amount of dollars in tax, then fine, that's all they really need to know. But understanding the cost of what your inventory is. How much inventory do you carry? How long does that sit on the shelf? Just simple things like that to understand where your capital is tied up. We're talking about the most efficient cost of capital. The most efficient capital is the capital that you can squeeze out of your business, right? That you're going to generate yourself. And so, no matter what kind of financing structure, whether it's equity or debt, the more efficient you can be in your business itself and understand that piece, that to me is the key.
And I'll follow up to that because I agree wholeheartedly with what he just said. Because most small businesses, the owner, you're the day-to-day of the part of the operation, and so a lot of times, they don't know what that balance sheet or that profit loss or you know,
Yeah.
inventory, accounts receivable. They're out there, you know, actually doing the work themselves and part of the day-to-day
The reason capital is that they have a short window of opportunity to get to an exit, and they're gonna hire in a VP of sales, and they're gonna hire in a CFO, and they're gonna hire in a VP of ops, that type of thing. And so you have this, it may be a startup, but these guys have done the startup 7 times, and so they really know what they're doing. And to Blake's point, a lot of our customers, you're the CEO, the COO, the VP of finance, you're washing the bottles in the back of the store, you know, the whole bit. And so it's very difficult to have a command of all those things. So that's why it's really important to have good advisors around you, a really good attorney, good CPA, good, even really insurance is important, and a good banker. And surround yourself with a team that you can go to and have advisors.
And I'll chime in just to round out your lenders. The number one thing I see is not knowing your market. So you're in the business, the market shifts on you, you're not paying attention to your financials, and then you get into an issue of, oh, the lights have to stay on, I've got to meet payroll. It's paying attention to your market. So in many instances, we start businesses and industries and markets we simply don't understand. We fall into it. Then if we don't understand, it impacts the financials. Because then you say, hey, my business shut down because I didn't get access to capital. Well, the access to capital wasn't your issue. Did you understand the market and the trends in your own market?
I think there's a lot of common mistakes in startup fundraising. I published a book recently on early stage fundraising. It's called Startup Success, and I devoted a whole chapter to the most common issues and mistakes that I see made, and maybe 2 that I'll mention. One is underestimating how long it's going to take to raise the round of funding. And I'll just use kind of the first real round of funding, a $500,000 seed round of funding. A lot of those startups came off of a bootstrap phase where they were using their own money, or maybe a small friends and family round. And this friends and family round, that wasn't that hard to raise $100,000 from Aunt Sally and Uncle Fred. So maybe it's going to be kind of like that when I raise $500,000. No, it's going to be a lot harder. And to raise $500,000 from angels at $25,000 a piece means you need 20 angel investors to say yes at 25 grand a pop. Okay. If 1 out of 5 says yes, that's 100 angel investors you need to meet, and you're not going to get 1 out of 5 to invest. It's going to be much worse than that. So the number of meetings, the amount of time, the herding cats that's involved is way, way underestimated.
Can you throw in there also with the time, that this is your GoFundMes, these are, isn't that tied in with that as well from your perspective? Because it takes a lot of time.
It does. Well, yeah, so to run a Kickstarter campaign or some
Yeah.
crowdfunding campaign, people think, if I build the page, they will come, and that is definitely not the case. There's a lot of energy and a lot of tricks and techniques that have to go
I
into
want
that.
to throw that in there as well.
Yeah. Second most common mistake would be focusing too much on the product and not on the business. I'll meet with a first-time founder, and all they're talking about is the whiz-bang features and how hard it was to develop this tech and then this and that and the other thing, and the patent we're thinking about filing. And I'll finally say, time out. Are you building a product or a company? I don't invest in products. I invest in companies because I need you to get to a big number, and it ain't all about the product. Let me tell you all the things when you're 10 million in revenue, here's all the things you're going to have. So I need you thinking about that. They're only thinking about, can I build the product?
And then one more point I'll make about, understanding your financials and how your business works, because this will also play into your personal finances as well, as far as, there has to be some forward, looking towards where you want to be and where you're going to be, not just within the business, but within your personal life too. As a small business owner, and too, this depends on how you're structured too and how you file, but as a small business owner, everybody's typically trying to write things off on their taxes, trying to, get the best out of that as possible. And a lot of the times when it comes to, say, they're wanting to buy a new house, family's grown, they need a bigger house, they come get a loan. Well, that's when regulation comes into play when it comes to real estate with debt to income ratios, which basically ruled the housing market since, the crash in 07, 08. And so I've had several customers, a lot of money in the bank with us, been doing business with us for years, but based on how we have to calculate that income and meet those regulatory factors, you know, basically he couldn't buy a candy bar. But you know, and then they just look at you, and that's where I'm the bad guy. It's like, well, I got all this money here, you financed all this stuff for me. Well, it just it's a new ball game at that point. It totally flips the script. So as you move forward with your business, you also got to think about where you're headed, you know, in your own personal life and with your family too, because it'll hit you like a brick wall once you know, come to that realization.
One of the things we talk about a lot in our company is, you know, balancing the time that we work in the business versus on the business. And you're kind of hearing that to some extent. If we're too much either way, then balls are getting dropped, and there's ultimately that's not going to work either. But to really be prepared for what these guys are going to scrutinize you for, you have to spend adequate time on the business so that you understand the business. And we see frequently people are ready they want to go to the bank and they want to get that debt, and then you look at their accounting and it's just absolutely a mess, right? Because there wasn't enough time spent on the business as well. So yeah, let's take some questions.
Quick question. So you mentioned thinking about where you're going. So our business is getting ready. We're about $500,000 a year in profit. But looking at 7 years from now, where we want to be, $100 million a year.
Need to be in serious trouble.
Yeah.
You bail me out of jail. You know, in general, you know, what you're thinking about is the right way, right? What is a 5 to 10 year plan, and what types of capital am I going to need to get there, right? If you're doing real estate development and it's project by project, what you want to be able to do is build that relationship with the right bank. There are some banks that do a lot of real estate development, and that's really their bread and butter. There's others that really don't do any at all. And there's some in between that do a lot of real estate development, but they will only do it if there's like a big equity investor into the deal. So the first thing, you know, for anybody's particular business is to find out what that institution does and does well. That's probably the first thing. And then work with that banker to say, okay, here's my 5 to 10 year plan. You know, are you going to be able to support me through that? Or what are the things that you have to bring to the table in order for the bank to work with you, right? And so then you can kind of flush out your business plan and have a strategic view of what kind of capital that you're going to have to go after and when you go after that.
Yeah,
Does that answer your question?
Yes.
Does that make sense?
Just a relationship piece. So Paul's point, because all the bankers are different, and that's what it is you really got to just search out. It's a relationship piece.
It's a big
It's a
relationship.
big relationship.
And I'm thinking the more commonality between those projects,
Yep.
the better. Are these projects pretty similar? Is it rinse and repeat? So if you show a formula of success of this, and I'm going to go find more just like that, similar demographics, similar size cities, similar square footage, similar whatever, versus if they're each very different, I would think that that'd be harder for an investor to commit to multiple of them.
That's a really good point.
Because you over leverage sometimes, and I get some of these, and in some of these deals, you get too aggressive. First, let's just get the one deal done, get it done, and then you try to over leverage and try to do 3, 4, 5 deals in a year. And that's what sometimes may scare the banker. Oh, okay, you're getting ahead of your skis. And to Gordon's point, you want to find the right one, because we'll tell you, nope, you do it this way. We'll give you the money, but the relationship is they have a stronger expertise in that area to kind of guide and mentor you into how to do those deals.
You can also go to those other advisors I was talking about. You know, if you have a really good lawyer who understands commercial real estate, chances are they're going to know what the funding sources are out there because they've worked on those transactions before.
Yeah.
And so you can use them as your guide to say, okay, of the 10 banks in town, who are the ones that really do what I do, and that'll narrow the field down to 3 to 5. Yeah, that type of thing.
Gordon mentioned how people tend to underestimate the time and the effort that it takes to go get this funding, and especially in banking with the regulatory environment that we're in, it's gotten even harder over recent years. So it's I understand the desire to have an efficient process because you're doing it so often, but just recognizing that even if it's extremely streamlined and you have the great relationship, it's still going to be quite an effort. I would also encourage you not to have just one relationship, but multiple relationships, because these banks, you want to keep them honest. You know, you want to be able to get multiple quotes on deals you're looking at. Any other questions from you guys before I move on? Okay, think them up. We gotta have some more questions. So one question that came up was just about the SBA lending, and I have a limited sample set with that, but in my experience, 8 out of 10 people I know that have tried to get SBA lending, they've failed, and the 2 that have succeeded, they'll never do it again. So talk a little bit about SBA lending and how you guys use that.
I'll start off, and then you guys can. So there's different types based on the different need. So BCL can do SBA lending. So your government's not a bank. That's not what they do. They utilize other partners, a CDFI, to do it'll start off if you want a micro loan at $50,000, that's an SBA loan. We do those. That's one type. Then there's Community Advantage. There's another type. What these are if you guys screw it up, the government's guaranteeing that we're going to get a percentage of our money back. And then it gets into bigger plays, which is 504, which is now you're doing, multi-million-dollar deals. And this is usually for real estate, is what it is. The key factor, I guess, with all of those is some of what we've already mentioned, at least what I see, is your preparedness. The financials to the business are crucial, even for the microloans at under 50K. We're looking at the basics. The Community Advantage is the same thing. We talked about, does the business generate revenue and profits? Because we got to get the money back. That's usually the case. And then the 504, if anybody else wants to chime in, gets to be more complicated because then you've got, 2 banks? You've got multiple players involved. So.
Yes. You want to go first? Or you want me to go?
Yeah, I'll touch on that. And to his point, and it goes back to having your financials and being prepared, on paper and having everything together and understanding those numbers. But on SBA, the decision, SBA doesn't actually do the lending; they're just doing the backing. So on all the different SBA programs, the rate is up to the lender discretion as long as it doesn't hit a max that they've set forward based off the prime rate. And then certain fees, that's a whole different story that can take a lot of time, but and then the approval process. And then too, that approval process, it has to be based on our policy, procedures, and to our requirements. And so you're essentially getting approved by us to get that SBA as is, but there's more red tape and a lot of more paper and a severe headache.
Yeah. Well, so to tie on to that, I started out traditional banking, went to tech, came back to traditional banking a few years ago, and the first thing I came back and my guy said, "Oh yeah, we do a lot of SBA lending." I thought, "Oh my God, I have not done an SBA lending in 25 years, and it was terrible." Right? Well, I will tell you that I have seen it now work multiple times, and it works really, really well for the right circumstance. There's a couple of things that you can mitigate the pain and the suffering. Sometimes it can kind of like be going to the doctor that you really don't want to go to. And so what the first thing I would say is, number one, seek out a lender that is a preferred lender. I don't know if you've heard that term or not, but there's a specific SBA package that has to be put together. And there are a lot of banks who are not preferred lenders that they will go to an outside party to prepare that. So the bank makes their decision, the outside party builds the package, and then it goes to the SBA, right, for their approval. Preferred lenders basically have a track record and have done enough SBA lending that the bank actually makes the decision first and then reports it. As long as the deal is within certain parameters, we have an inside group that underwrites the deal, puts the package together, does the deal, funds the deal, and says, SBA, we got it done. That's on a 7A program. There's multiple programs, and again, we've spent 4 hours talking about it, but that's on that kind of program. What Brian was talking about on a 504 deal, you have the bank making half the loan, a community development corp making the other half, and the same thing, if you're a preferred lender within certain railings, you can get the deal done a lot faster. So those are the kind of questions you want to ask in terms of, are you preferred, are you not preferred, and how does your process work? Do you prepare the package inside the bank? Do you have a third party doing it? The less outside parties you can have, the easier it is to get through that process.
And you've got 2, 3, you've got People Fund sitting out here, they do Community Advantage 7A, Lift Fund does it as well. Final things I would say, that I always use the 4 C's on all this, right? First one, credit score 640 or better, no bankruptcies. Second one, I call it character and condition. It's really, actually it's you, and then I just say it's where the business is. Character to me just more around what do you understand and know about running a business and the financials. Condition is where the business is in the life cycle. Capacity and capability, we've talked about it. Hey, you got to address it. Can you afford the loan? If the business is only doing 50,000, you're asking me for 150,000 or 200,000. What is that? That's probably $1,000, $15 a month, $1,500, $2,000 a month hit to your cash flow, right? And then we talked about the last one, collateral. So those, when it comes even to the SBA, on the paperwork, things of that nature, if you can address those 4 C's, then you're in a better position. Mr. Lender, I'm seeking 50,000. As you can see, my credit score is this. I have capacity to repay back the loan, and you can see our profits here. And if you need collateral, I have 25,000. I've got 2 cars and a motorcycle that my husband doesn't need. You know?
Any questions out here? I recently went to a panel, and I was just thinking, when we did the raise of hands earlier, how established these companies are, only a couple of hands went up as more than 10 years, right? Which means the businesses represented here have not lived through a recession. And I was recently at a conference, and the CEO of Goldman Sachs was speaking, and he mentioned that the recession, we're at the tail end of this cycle, and the recession is just a matter of when, right? And would it be 2019 or is it going to be in 2020? But it's right around the corner. So in your businesses, how are you doing kind of the economy as a whole now, and how is it starting to affect your decisions?
We just had a round of meetings with our chief economist, and the outlook from our chief economist and our chief investment officer is still fairly bullish. Yeah. The issue is, nobody wants to talk about the R word, right? But invariably, if the accountant doesn't make you nervous, then he's probably not doing his job. So the outlook is fairly bullish, but there are a lot of factors that could really tank the economy quickly. Some of those are political, some of those are economic. There is definitely softening in certain sectors. Amazon is creating havoc across lots of different industries, that type of thing. So I wouldn't stand up here and wave the R word in front of everybody, but I would be really mindful of it.
Is it affecting your risk profile in terms of how you're evaluating deals? The risk you're willing to take?
Sure. I mean, one of the fundamental things you look at from a credit perspective is how does a business operate in a recession? And so those businesses that did live through a recession and could demonstrate how they got through it, those are a lot easier credit discussions than ones that haven't done it.
It's where the business is, and it's like the ideation stage. I just got an idea, and I'm taking the boat out in the water. That's one phase that we look at. The other is, if it's an existing business, I mentioned it before, understand the market and the industries that you're in. And do you have a product or service that's recession-proof? To your point, there's certain businesses, that are recession-proof. Probably you can go through a recession and you still buy popcorn for some reason, versus other things. Other med spa businesses is one that's popping up a lot. Do I put groceries on the table? Or, hey, exactly. And these are individual decisions, persona. Now we're from market down to the persona of the individual who's actually going to buy the product that speaks to this on, does that product or service you offer, is it recession proof? And then when I'm looking at it from a lender standpoint, it starts to make sense. Yeah, okay. That product, probably, we've got the financials, yep, they know the market pretty well, then that's what we look at.
Well, what about from an equity perspective? Does the economic cycle impact you guys?
A little bit. I would say as an advisor to our portfolio startups, we're probably cautioning them to be careful about their burn rate. And you know, if they're raising a round of funding, if they're raising $1 million, but there's a little bit of extra demand, and they come back and say, hey, Gordon, I think I could raise 1.25. Do you think I should? Before they even finish the sentence, I say yes. Like, if there's a little bit extra, absolutely. Go ahead and raise a little bit extra. Put it under the mattress if you need. You don't have to spend it. On the investor side, as a VC, remember, we raise money from limited partners and get money in a bank account. We have to invest it. We can't just sit around and wait for a couple of years or whatever. And the truth is, since the money's already in the bank and we need to invest it over a 3 or 4 year period of the life of the fund, actually, if a recession does hit, the valuations get a little better and we might get a little bit more aggressive. We can get in at $3 million valuations instead of 5.
Yeah.
And wow, that's a pretty big difference.
And note this, SBA data, recessions have had no impact on the natural startup and failure of businesses in this country. That data goes back over 30 years. It does not have stayed the same for 30 years. You just need to understand how to improve your odds.
So we're down to less than 5 minutes. Any questions that you guys have for the panel? Yes, sir.
I guess one question I have is, in the end of the day for you all, is it more a personal decision or a technical decision based on the financial of the business? And what is the best way for somebody who may be really good, you know, at working his business? Should he bring in a professional to try and have that last conversation with you? Or do you say it's really the man that or the woman that you're making the loan decision for?
I think it depends on what kind of capital you're talking about, and I'll let Gordon address that first.
But, so the first thought, you know, at the very beginning of this book that I wrote, I described there's 2 reasons to raise money. You raise money out of want or out of need. And those are dramatically different motivations, and the whole experience with the investors is different. Most of the startups I work with, they raise money out of need. If they don't, they'll crash and burn. They can't keep reaching into the bank account and bootstrap longer, right? Out of want, and so many small businesses, I see that they're in a position of raising out of want. They've got a business that's cash flowing a little bit, but they have an aspiration for expanding the business. But it's want versus need is a really big difference to think about.
From my side of it, it's a combination of both. So when I mentioned the character and condition, it's about you.
For sure.
It's about you. Do you give me a warm and fuzzy? Are you passionate about the business? We just did a $275,000 loan to a HR staffing startup business, and we're talking within 2 years it's gone from $75,000 to $850,000 in revenue. Growth hurts badly. But the key was what you mentioned. What do you want to do? Where are you taking the business? What are some of your challenges? And this was an entrepreneur that was open to, hey, I don't know what I don't know. Here's what I do to learn from my mistakes and continue to move forward. Here's what I believe in the leadership. Those things make an impact to us. And then more importantly, he was able to articulate what kind of relationship he wanted to have with us. So then it opens up to, oh, okay, he wants a partner that can grow with him, things of that nature. So with us, it's a little bit of both. You got to have the collateral, all these other things. But then in many instances, it's about you.
I think probably just real quick with Blake and I, the personal thing is really important, right? To understand the character. But at the end of the day, we're in a regulated environment, and so the numbers are going to speak first, and we're going to have to be within a certain kind of range when it comes to the financials itself. So again, I would kind of say, go to your advisors, go to your accountant, and say, where do I fit here? And if you want to bring that accountant in with you, if you feel uncomfortable explaining those numbers, then bring them in. If you feel totally comfortable with doing it yourself, then by all means, it's always better coming from the owner of the business, for sure. You know, the only other thing I'll say is, you know, there's, the only certainty in projections is that they're wrong. You're either gonna be
That's a good
above them,
one.
or you're gonna be below them, but both of those represent risk. And so you need to understand going into it, if you're talking about projections, they're gonna be wrong.
They're nothing but pretty numbers and words. That's what, to me, that's all they are. Those are just pretty numbers on the spreadsheet.
To the second question about bringing in a professional, you know, I've noticed with the effort that's required, as we talked about earlier, in the regulations that you guys have, I'm seeing more and more people use some additional expertise to come help them through this process.
Advisors of some sort,
Yeah.
Even if they don't come to the meeting, just preparing you for, you know, the strategy and preparing for the financing and what terms might be reasonable, so they could be a behind-the-scenes advisor maybe more than just sitting at the table with you.
Yeah, one more question we
We have a
had.
question in the back.
Oh, I'm sorry, it's right here.
My quick question is, if you go this route and you get turned down for all the right reasons, wrong reasons, obviously for the person getting turned down, there's not the right reasons, what, if anything, can that person do to further either stay engaged or further educate themselves and further burnish and polish their potential to go revisit that, if you will?
That's a good
Knowing that it's certainly in the bank world, it's a plug and play, and you know, as great as you are, and as funny as you can be, and as nice as your handshake is. But I guess that's my question: what kind of continuing education can somebody seek out?
Sure.
What do you suggest, if anything?
Debt and equity, that's gonna be a different answer. But from the bank standpoint, it's kind of what Brian said earlier, it's about building a relationship, right? If it doesn't work today from a bank standpoint, talk to that banker about, okay, what are my alternatives? One is, you know, you start a depository relationship with the bank, you kind of build that over time, and in the interim between bank financing and that point, you may have to go to an alternative source of financing. So like a factoring company to factor your receivables, something like that, do that for year and a half. Higher cost of capital, but at least you can grow the business, right? Once you've proven kind of that track record, you get the profitability in line, then you can come back. But at least at that point, you're an existing customer of the bank.
Yeah.
That's a big deal, right? We can do things for existing customers that we really can't do for new customers, just because that relationship is already there.
And Paul, isn't that the easiest thing? They just have to hear the recommendations, it's just come back.
Right.
It's
That's the main
just-
thing, is understand, why did you get rejected?
Exactly.
Why did you get the no's? If you get 10 different answers, that's frustrating. But if you really listen, this is the thing, the owners and the founders, they're so biased and they're so bought in, it's
Yeah.
hard for them to hear the real reasons, but really understand what was the reason this didn't happen, and then go work on that. It's usually gonna be less about needing to get education. They're gonna want more collateral, they're gonna want more revenue, they're gonna want to see more repeat. They'd like you to have a partner in the business, not just you, or there's usually some factor that's something you can go solve over time.
Remember, character and conditions, it's about you. Got one more in the back.
Can I take one more question? Yes, sir.
Yeah, mine was more back on the recession. Your experts say we're still looking bullish, but there could be cautionary standards. Are they looking more of a pullback, or they think there's more of a full recession down the road?
Well-
Yes, but, you know.
Okay, so the easy answer to that is there will be a recession. The only question is when and how long it's going to last and how deep it is, right? That's really the real issue. So, and I'm not an economist, and I won't remember all the numbers, but they basically break down all the different sectors of the economy and which parts are doing well, which ones aren't. Right now, really the consumer piece of the economy is what's really holding things together. That's the strongest piece of our economy. And the thing that probably will influence a recession is something that's going to impact that consumer spending. So is there a political upheaval that all of a sudden people start pulling back? Is there, does the trade stuff with China ramp up or migrate to a place that makes people uncomfortable so they stop spending consumer dollars? That is probably where you're gonna hit it. And the thing that throws some noise into the mix, again, I kind of joked about Amazon creating havoc. The buying habits of the American public are changing pretty dramatically. And so the question is that consumer spending is it declining or increasing, or is it just we're shifting the way we're buying products? So that part is kind of hard to figure out.
You might want to do some what-if scenario planning. This is just healthy business. Do a what if your business dropped by 20% a month? What if it dropped by 40%? Every year as I ran tech companies, I did what I called a mock layoff. I presented the executive team with a scenario, and we went through a layoff as if it were a real deal. And the truth is, we knew that we weren't going to have to do the layoff, but as a result of doing it, we identified dead weight in the company, stupid programs that we should shut down, and it helped me keep a more well-oiled machine, and I did it every single year. So I would recommend go through a scenario planning, do a what if, and then make it kind of real. What would you do if?
Don't let your passion blind you. What we're getting at is many times you get so passionately wrapped up in what it is, it blinds you. It blinds you. So that's what you got to do in the forest for the trees. Your forest looks great. It's all the trees, which is the risk.
Well, we're at the end of time, but thank you to the panel.